To consider investments, we need to define two key terms. The entity that owns the stock of the corporation is the investor. The corporation that issues the stock is the investee. If you own some shares of ABC common stock, you are an investor and ABC is the investee. An investment is an asset to the investor. The investment may be short-term or long-term. Short-term investments in marketable equity or debt securities are current assets. They can be classified as either trading, held to maturity, or available for sale, depending on management's intent and ability to hold them until they mature. To be listed as short-term on the balance sheet, the investment must be liquid or readily convertible to cash. The investor must intend either to convert the investment to cash within 1 year or use it to pay a current liability. Investments that aren't short-term are listed as long-term investments, a category of non-current assets. Long-term investments include stocks and bonds that the investor expects to hold for longer than 1 year. This table shows where short-term and long-term investments appear on the balance sheet. Assets are listed in order of liquidity. Long-term investments are less liquid than current assets, but more liquid than property, plant, and equipment. Short-term investments are reported immediately after cash. Next, we want to talk about how to analyze and report investments that are considered held-to-maturity debt securities. The major investors in bonds are financial institutions such as pension plans, mutual funds, and insurance companies. The relationship between the issuing corporation and the investor or bondholder may be diagrammed as seen here. If the investor company intends to hold debt securities longer than a year but not until maturity, they are categorized as available for sale securities and accounted for under the fair value method, which we will talk about later. If the investing company intends to hold a debt security until maturity, it accounts for the security at amortized cost as a held-to-maturity investment. Like other forms of debt, bonds pay investors interest, usually semi-annually, which is twice a year. The face or interest rate of a particular bond is quoted at the face of the instrument and determines the cash amount of semi-annual interest the debtor company pays. Bonds are usually issued in 1,000 face or par value denominations, but they typically do not sell at par value. The price of a bond at any particular time is quoted as a percentage of its par value. Market prices of bonds fluctuate with market interest rates. If market rates on competing instruments are higher than the face rate of interest on a particular bond, the bond sells at a discount, or below 100% of the face value. If market rates are lower than the face rate of interest on the bonds being considered, the bond sells at a premium, or above 100% of par value. Held-to-maturity investments are reported by the amortized cost method, which determines the carrying amount. Bond investments are initially recorded at cost, that is, market price as a percentage times the par value of bonds issued. At each semi-annual interest payment date, the investor records interest revenue. In addition, whenever there is issue premium or discount, it is amortized by adjusting the carrying amount of the bond upward or downward toward its par or face value, with an offsetting entry being made to interest revenue. Years later then, at maturity, the carrying amount will have been adjusted from the original issue date or original issue amount to its par or face value, and the investor will receive the face amount upon redemption of the bond. So suppose a company purchases $10,000 of 6% bonds at a price of 95.2 on April 1, 2012. The investor intends to hold the bond as a long-term investment until their maturity. Interest dates are April 1 and October 1. Because these bonds mature on April 1, 2016, they will be outstanding for 4 years or 48 months. In this case, the investor pays a discount price for the bonds. That's 95.2% of face value. And so when we buy them, on April 1, we debit long-term investments in bonds and credit cash for the amount we paid for them, or $9,520. The company must amortize the bonds carrying amount from cost of $9,520 up to the $10,000 over their term to maturity. We'll assume the company amortizes discounts on bonds by the straight line method. So these entries show that discount. The second entry on October 1 records the semi-annual interest payment we received of $300, where we're debiting cash and crediting interest revenue. And then October 1, to amortize the portion of the discount that has to be amortized, we're debiting the long-term investment in bonds and crediting interest revenue. This amortization entry has two effects. It increases the long-term investment account so that as it grows toward maturity, it reaches the par value of the bonds, and it records the interest revenue earned from the increase in the carrying amount of the investment. So next we want to understand how to analyze and report investments in the available for sale security category. Available for sale securities may be debt securities not held to maturity or equity securities such as stock other than trading securities. Cost is used only as the initial amount for recording the purchase of these investments. At the end of each reporting period, these securities are adjusted to their current fair values because the company expects to sell the investments at these values at some point in the future, although not within the next year. The accounting rules for long-term investments in stock depend on the percentage of ownership by the investor. The accounting method typically used are shown in this table. An investment less than 20% is considered available for sale because the investor usually has little or no influence on the investee, in which case the strategy would be to hold the investment, making it available for sale in periods beyond the end of the fiscal year. Ownership interest between 20 and 50% provides the investor with the opportunity to significantly influence the investee's operating decisions and policies over the long run. An investment above 50% allows the investor a great deal of long-term influence and perhaps even control over the investee company. Suppose a company purchases 1,000 shares of Hewlett-Packard common stock at a price of $44. The company intends to hold this investment for longer than a year and therefore treats it as a long-term available for sale investment. The entry to record the investment is shown here. Assume that the company receives a 20-cent cash dividend on the Hewlett-Packard stock. The entry to record receipt of the dividend is also shown here. So you can see that when we bought the investment, we debited the long-term investment account for what it cost us of $44,000 and we credited cash. And then on November 14th, when we received the 20-cent per stock dividend, we debited cash and credited dividend revenue. So GAAP requires that companies adjust their portfolios of available for sale securities to fair value as of the balance sheet date. The entry to adjust the investment account to market depends on if the market value is greater than or less than the last carrying amount. If the market value is greater, allowance to adjust investments to market is debited and unrealized gain on investment is credited. If the market value is less, unadjusted loss on investment is debited and the allowance to adjust investment to market is credited. The carrying amount of the investment is determined by adding or subtracting the allowance to adjust investment to market from the investment's original cost. If the fair value exceeds cost, the allowance to adjust investment to market will have a debit balance and will be added. If the fair value is less than cost, the allowance to adjust investment to market will have a credit balance and will be subtracted. And so if the fair value of the investment declines, the company debits unrealized loss on investment. Unrealized gains and losses result from changes in fair values, not from the sales of investments. The available for sale investments, the unrealized gain account or the unrealized loss account is reported as an element of other comprehensive income, which is really just a change in owner's equity that bypasses net income. Reported in a separate statement of comprehensive reported in a separate statement of comprehensive income or in a separate section of the income statement below net income on a combined statement of income and comprehensive income. And so the sale of an available for sale investment usually results in a realized gain or loss. When an investment for sale asset that has been revalued is subsequently sold, the amount of unrealized gain or loss existing on the asset at the date of the sale is reversed, effectively returning the carrying value of the portion of the asset sold to its original cost. Realized gains and losses on the investment are then measured as the difference between the amount received from the sale and the cost of the investment at the sale date. And so let's walk through an example of this. Using exercise 8-13A, journalize the following long-term available for sale securities of Roya Brothers department stores. So for item A, we purchased 410 shares of Fordham Foods common stock at $35 per share with the intent of holding the stock for the indefinite future. And so here we purchased the stock, so we made an investment, we debit the long-term investment, and we credit cash for the amount of the purchase. For item B, we received a cash dividend of $1.80 per share, which amounted to $738. So we received cash, we debit cash, and this is a form of revenue, it's dividend revenue, and so we credit our dividend revenue account. And then for item C, at year end, we adjust the investment account to fair value of $42 per share. And so the difference between $35 and $42, or $7 per share at using 410 shares, amounts to a $2,870 unrealized gain on investment, which becomes a credit because it increased in value, and we debit the allowance to adjust investment to market account for the same. And so continuing on then with one last transaction, we assume that we sold the Fordham stock for a price of $27 per share. And here you can see to record that then we reversed the previous adjustment based on the year-end value to get the account balance back to the original investment amount. So we reversed the $2,870 entry, and then we record the sale of the stock. We received $27 per share. We have 410 shares, so we received cash of $11,070. We zero out the long-term investment account, what it originally cost us of $14,350, and the difference between the two becomes a loss on the sale of investment, which is a debit. And so next we want to discuss how to analyze and report investments in affiliated companies using what we call the equity method. So an investor with a stock holding between 20% and 50% of the investee's voting stock may significantly influence the investee. Such an investor can probably affect dividend policy, product lines, and other important matters. Investments accounted for by the equity method are recorded initially at cost. Under the equity method, the investor applies its percentage of ownership in recording its share of the investee's net income and dividends. When the investee reports net income, the investor records its share based on the percentage of ownership held. The investor increases the investment account and records investment revenues when the investee reports income. As the investee's owner's equity increases, so does the investment account on the investor's books. The investment account is decreased for the receipt of dividend on the equity investment method. We ask why? Well, it's because the dividend decreases the investee's owner's equity and thus the investor's investment. The investor is receiving a cash return on part of the net income that increased the investment account, so it should make sense that the investment account would be decreased. And these entries show how to record the investee's share of net income and receipt of cash dividends. The T account above shows the increases and decreases to an equity method investment. The account is increased by the investor's share of investee income and decreased by any investee losses and dividends. So let's walk through a problem or an example of how to make these entries. We'll use exercise 8-15A. McLeod Corporation owns equity method investments in several companies. Suppose McLeod paid $1.8 million for a 40% investment in Simpson Software Company. Simpson subsequently reported net income of $666,000 for the first year and declared and paid cash dividends of $460,000. So, date item A, we can see records the $1.8 million investments. We simply debit our long-term investment account and credit cash. Item B records the portion of Simpson Software's net income. And so they declared net income of $660,000, 40% of which was ours based on our ownership percentage. So we debited our long-term investment for another $264,000 and recorded equity method investment revenue of $264,000. And then we record our 40% share of the $460,000 dividend paid, or item C. So we receive cash of $184,000 and debit the cash account and credit the long-term investment account for $184,000. And this T account then shows us that based on these entries, the balance in the investment account and for McLeod at the end of the year would be $1,880,000. And so this concludes Part 1 of Chapter 8. Please understand this is not meant to substitute as reading, so please go back and read the chapter closely and make sure you're comfortable with all the concepts that are discussed, and then move on to Part 2 of the Chapter 8 presentation. Thank you very much.